Welcome to the Debt Crisis Problem Podcast, your source for insights into major risk events that could trigger an economic downturn and debt crisis. Today we're addressing another key risk, high interest rates. Our goal is to create risk awareness and spark a healthy debate for the average citizen. The world is too fragile to wait. We need fresh candor and common sense. A debt crisis looms due to unsustainable debt and deficit spending everywhere. It's time to wake up and speak up. Let's get started. Let's start with the history of low interest rates by the Federal Reserve, and for many years since the Great Recession. And why is that? According to an interview with George Washington University, former chair of the Federal Reserve, Janet Yellen, back in February of 2020, this exchange went as follows, quote, "Let's talk about interest rates, Dr. Yellen. You have said you're a little worried about interest rates being so low for so long. Explain." Well, there are several pieces to that, mainly low interest rates, which you can lay at the feet of the central banks. But central banks are trying to keep their economies operating near potential and at this point trying to boost inflation rather than lower it. And the reason they have set interest rates as low as they are is because they're operating in an environment where that seems absolutely necessary to keep inflation running at moderate levels. So I worry about the low interest rates because it is a symptom of a deeper problem in the global economy, and it is ultimately putting central banks in a position where they don't have a lot of ammunition. If we have a serious recession, we're probably not going to be able to count on central banks to offer up a significant response. And then the last point I'd like to make is that in a chronically low interest rate world, which is what it looks like we can expect going forward, we do have to worry about risk-taking and the possibility of financial imbalances building. Interest rates, in my opinion, should have been raised earlier. The Fed funds rate was kept purposely low at or near zero from December of 2008 for the next 10 years, peaked again at around just 2% in July of 2019, and then dropped back to near zero in April of 2020, the time when the COVID pandemic picked up. To me, the 10-year period of ultra-low interest rates was not warranted. The Federal Reserve politicized its monetary policy by not raising rates sooner, in my opinion. I believe interest rates were intentionally kept low to stimulate the economy longer than was needed. Everyone was used to the low interest rates that were artificially lower than they should have been. The ultra-low interest rate environment stimulated the economy, fought deflation, juiced the housing market, reduced unemployment, helped the banks, lowered borrowing costs for consumers so they'd spend more, and boosted stocks. It also left us in a vulnerable position to fight against an emergency like the COVID-19 pandemic when interest rates dropped back to zero. The COVID-19 pandemic helped fuel an asset bubble in housing pricing, together with trillions of dollars in deficit spending and more stimulus. This created inflationary pressures where in June of 2022, U.S. inflation hit a 40-year high, 9.1%. I would argue that the Federal Reserve Bank juiced the economy much longer than was necessary during this 10-year period, and thus had to raise interest rates sooner, higher, and longer than most people expected. I call the root cause of all this politics. The Federal Reserve is supposed to be independent, but I'm afraid it has other interests at heart and has drifted away from its true mission. Is the Federal Reserve supposed to sit idly by and fund all the deficit spending forever and not itself become accountable? After all, it is a bank, right? But no, it will print money forever because of politics. Why does it view its mission to keep funding soaring deficit spending and not stop it without a vigorous public debate of the damage these deficits are causing? Have you heard anything more than a whimper by the Federal Reserve Bank, acting like a real independent bank, making its own decisions with the long-term interests of the American people in mind, or just caving to the political winds all the time? Why doesn't it pound its fist and raise a genuine warning for all America to see? Why did it allow the Great Recession to happen when it could have done something, or at least sounded a red flag warning or something about the growing risks well beforehand? Where was its voice when it saw all the contributing factors to the Great Recession and did little to nothing about it other than to signal that things were okay? That can't happen, and then to say after it did happen that a depression was averted? Somebody has to be responsible for it. Being responsible means accountability too. If not the Federal Reserve, then who? Congress? Yes, of course. But the Federal Reserve Bank is the central bank of the U.S. It should have stood up like a real bank and said no once in a while. If it claims to not be responsible, then who is? Might they tell us? The problems persist to this very day. Some bank. The Federal Reserve Bank deserves to have lost trust. Janet Yellen served in the Clinton administration in 1997 through 1999 as chair of the Council of Economic Advisors and president and CEO of the Federal Reserve Bank of San Francisco from 2004 to 2010. She was the vice chair of the Board of Governors of the Federal Reserve System from 2010 to 2014 and chair of the Federal Reserve Board from 2014 to 2018. She became the U.S. Treasury Secretary in 2021 to the present. Notably, starting in 2010, while serving as Fed Chair, multiple unsustainability warnings were issued by Fed Chair Janet Yellen. Her tune changed when, as U.S. Secretary, she no longer issues such warnings. Rather, she's gone political and mainly concerned about being able to make the interest payments on the U.S. debt load. The current chair, Jerome Powell, in my opinion, his voice isn't making enough of a difference. It's doubtful the public really knows him or where he stands. He continues the same policies of printing more and more money and now had no choice but to raise interest rates over the past few years. But where is his needed voice in all of this? Where did he demand the U.S. government get on a budget, stop the deficit spending, issue warnings, anything? He simply prints more and more and tells Congress in the same plain voice that we need to do better. Nonsense. And now we find ourselves in a predicament. The U.S. is unprepared on a multitude of fronts. To confront these risks, the Federal Reserve Bank will just continue to print more and more money to cover an ever-increasingly high deficit. Chair Powell won't speak up like he should because he can't reveal the true nature of the problem we now have without causing panic. So we just march along until the music stops one day, and we find that there are not enough seats to stay on in the game. Then, when the music does stop, real panic will ensue. Meanwhile, the Federal Reserve Bank, in my opinion, is not to be trusted. I believe it has simply become more and more political over the years. It has failed to protect the interests of the American people and its financial well-being. Janet Yellen's voice has only been a whimper, and no one can even hear her or what she really stands for anymore. The same goes for Jerome Powell. There are plenty of others out there that are also responsible too, including elected U.S. government officials, bank supervision and regulatory agencies, the groupthink economists, bankers, investors, credit rating agencies, etc. Sure, besides becoming very wealthy, they'll all have plenty of nice arguments to defend their inactions. But at the end of the day, they go away fat and happy. America, we the people, are the big losers as a result. Now, do not pretend that we the people, our society, are not also stakeholders in this mess. We are accountable too. Society wanted and voted for all of the deficit spending through our elected political leaders who appointed all these officials and experts that run these enterprises. We get what we really want. And we get the natural consequences that must needs come too. Now we're stuck. And we do all we can to postpone the inevitable, right? But accountability can be stingingly difficult, like the touching of a hot stove. The consequences and days of reckoning of our financial house of cards will soon come too. Now, interest rates have moved high by the same Federal Reserve Bank. Higher interest rates have big consequences. To combat inflation, or high costs, by slowing down the economy beginning in the first quarter of 2021, the Federal Reserve increased interest rates 15 times, or by 3.75% in total. Higher rates make it more expensive to borrow money, and people will start cutting back on their spending, which slows down an inflated economy. It is the expectation that less consumer demand will result in the lowering of prices. During the QE or easy money years following the 2008 Great Recession and the 2020 COVID-19 pandemic, the level of U.S. government debt soared and ballooned to very high levels. To fund the new debt, central banks purchased large amounts of securities on their own balance sheets to help keep interest rates low and stimulate the economy. Now, with higher inflation and interest rates, will there not be less interest in purchasing the securities in the future to fund more government spending? With the exceedingly high levels of U.S. government and private debt, will not these higher interest rates push highly leveraged businesses and individuals into default and bankruptcy? The more this goes on, won't there be a ton of economic disruptions for businesses and even social problems as families and marriages suffer? Of course it will. This short ad is sponsored by the TunaBudget.com podcast. Hey friends, looking to improve your personal and family financial wellness? Don't miss the Tuna Budget podcasts at TunaBudget.com. Download your free Tuna Budget Worksheet Plan, the most powerful budget worksheet plan in the world, yours. In addition, dozens of Tuna Budget's human-side candid conversation memos may be the perfect answers you're looking for. Join us for real candid conversations and candid questions that can change your life for the better. Subscribe to the TunaBudget.com podcasts and empower yourself to take advantage of your future and financial well-being. So, what will happen to enslaved borrowers who have heavy debt and the value of their underlying assets when interest rates increase? We live in a world that uses an overabundance of debt. Debt at higher interest rates result in much higher debt service payments. In many cases, loans are structured to have interest-only payments, while others are fully amortized or repaid over the term of the loan. If loans are restructured with higher interest rates, the obviously higher payment amounts may kill the deal in the first place. It's just too expensive, and that's why the Federal Reserve Bank raises interest rates in the first place, to slow down the economy by reduced debt spending. This is supposed to stop price increases and eventually reduce inflated prices. But what do you do if you already have a low interest rate debt outstanding that's going to mature in a high interest rate environment? The examples I'm going to share with you in a few minutes will show what can happen to those who are in a precarious situation with heavy debt. If you currently have a low interest rate deal and will need to refinance with a higher interest rate, you'll see how much more interest that's going to have to be paid for that same debt. But in today's world, every dollar counts in this high-cost economy. Just think what you could do with the extra money if you didn't have to pay so much at the higher interest rate. The same holds true for a mortgage, a small business loan, or to refinance a building or a business. The extra interest expense can increase to the point it can put you or a company or a country out of business. While interest rates have increased in the past year or so and are less than in prior decades, they are very high now in comparison to what they were just a few years earlier. For example, if you had a 3% loan and are now refinancing at 6.65, that amounts to a 122% increase in the rate that you were paying before. So take a good look at these examples and see how heavy the debt burden becomes when you compare the low interest rate versus the high interest rate environment on the consumer, a small business, or a commercial real estate loan. Somewhere, somehow, every borrower is going to have to come up with the extra money to make the required payments, or else he will default. And higher interest rates put downward pressure on the underlying collateral values as well. In the end, all that extra interest isn't being used to purchase anything. The money is just being paid to the bank instead of buying inventory or paying salaries or whatever. Banks love their long-term borrowers who are enslaved with heavy debt burdens. You have to ask yourself if it's really worth it. Surely you are fully aware of refinance risk and the possibility you'd need to pay a ton more interest each month if you needed to refinance. What will happen to enslaved borrowers as interest rates climb and the underlying assets decline in value? That's when things get interesting. Let's look at some different types of loans and how much extra interest might have to be repaid once a loan matures and you have to refinance it at a higher rate. For a consumer, let's take a credit card. Say in 2022, your $10,000 credit card was at 16%, and it's payable over 6 years at $217 a month, and you'd pay $5,600 in interest. Now, fast forward here to 2024, that same $10,000 is going to cost you 22.75%, payable over the next 6 years at $256 a month, which means $8,412 in interest. The consumer would have to pay an extra $2,800 in interest, an increase of 50% in cost. On a residential mortgage, let's go back to December of 2020, $550,000, 2.7%, 30 years, $2,231 a month, a total of $253,100 in interest. Fast forward to early 2024, $550,000, 7%, same 30 years, payment of $3,660 instead, a total of $767,300 in interest, and the consumer would have to pay an extra $514,200 in interest, an increase of 203% in cost. A small business, say they have a $765,000 10-year term at 5%, payments of $8,114, a total of $208,700 in interest. Fast forward to early 2024, same $765,000, not 5%, now 10.5%, same 10-year term, monthly payment goes up to $10,325 or $473,700 in interest. That business owner would have to pay an extra $265,000, an increase of 127%. Let's say there's a commercial real estate loan. Back in 2022, $10.9 million, 3%, 25-year term, monthly payments of $51,650, a total of $4.6 million in interest. Early 2024, that same $10.9 million, now not 3%, but 6.5%, same 25-year term, it's $73,530 a month, or $11,169,000 in interest. The investor owner would have to pay an extra $6,566,000, an increase of 143%. Wow. In conclusion, so what, when, and how does higher interest rate risk affect you? Higher interest rates can sink the ship. Interest rates are like a two-edged sword. On one hand, if rates are too low, they could fuel inflation and cause asset values to unnaturally expand like a bubble, an asset bubble. If rates are raised too much, that could push the economy into recession. So how do interest rates affect the debt owed by the U.S. government? Interest expense is regularly paid on the U.S. debt or bonds until the bond matures or is due, when the full balance must be repaid. The unpaid balances are usually refinanced with another new bond, but now at a much higher interest rate. People are becoming rightfully and increasingly concerned about the high percentage of all U.S. government spending that's being spent just on the interest payments of U.S. bonds. It's over $1 trillion a year now, just the interest payments. It's like your credit card making the minimum payments on an ever-increasing balance that is taking up more and more of your check each month as the interest rate increases. And with all that, the bank is now increasing the interest rate you pay, which will take up even more of your budget. Well, the same is happening at the national level at the U.S. Treasury. They issue bonds to finance its deficit spending. And as a percentage of its total spending, more and more is going to just the interest payments, while the maturing bonds are being refinanced with new bonds but at much higher interest rates. Effectively, it is taking more debt just to pay the interest payments. It would be like you getting a new credit card to pay off an old credit card or old credit cards and just to make the interest payments on those older credit cards, which is beyond insane. None of this is sustainable. If it is not sustainable to you, if you have heavy debt or overwhelming debt, it is not sustainable to the U.S. government without causing a debt crisis. And as you'd imagine, the pressure is building. How long could you afford to pay more and more of your income just on interest-only debt? And who is going to give you another credit card, at low rates if any, so that you can use that new credit card just to pay the interest on your old cards? Again, that's already happening on a national level. How long could you afford to keep living off credit cards without your ship sinking? Again, the same thing is happening on a national level. Keep in mind the amount of interest paid on the national debt will soon surpass the amount of money it spends on the U.S. government, national defense, and its security. In fact, it just passed that. It is estimated that the interest cost now has reached nearly $2 billion every day, 7 days a week. Clearly an unsustainable course that is more than likely to increase and get worse, which makes it increasingly unsustainable. Interest never even takes a nap, not even for a single minute. Anyone who argues that we can still afford the interest payments will go away silently someday when there's just another massive interest rate shock and we all go into default and restructure mode. It's called a debt crisis. The first question they'd need to be asked should be, where was your warning voice before we got into this mess? Can you smell a debt crisis yet? Thank you for joining us. Today we explored high interest rates, a major risk contributing to the looming debt crisis. We hope to highlight the urgent need for transparency around these risks. We want to hear from you. Submit your own debt crisis memo and share your thoughts at tunabudget.com. If you found today's episode valuable, please subscribe for future podcasts. Your support helps us grow this healthy debate. Until next time, take all necessary precautions. Your financial wellness matters. Thanks again.